Hello, everyone.
Komal, you can confirm the screen is seen.
Yes, so I can see the screen. Hello, everyone. Good morning.
And
We
this,
welcome you on a lovely Saturday morning. We will start sharply at 11:05 a.m.
and Komal, the screen is also getting changed.
Yes, sir. I can
Perfect.
also see your pointer.
Thanks.
Hello, everyone. We're very grateful that you all have joined on a lovely Saturday evening. Today's event webinar is very special because we at FPS Assets have started a new format. Today, we'll be answering all the questions clients have in their minds. We have gathered a set of 12 questions that we'll be answering, and at the end of Q&A session, we'll also answer the questions you have. So starting with the intro of the speaker today, we have Mr. G.R. Balaji sir. He has been an ex-fund manager and has been in the industry for the past 2 decades. He's currently the CIO and co-founder of First Principal Assets. Before starting, we would like to give a disclaimer that this event is only for educational purpose and any conversation does not constitute an investment advice. Over to you, Jia sir.
Okay, thanks, Komal. Very good morning to all on a lovely Saturday. As Komal told, for the first time with FPS Assets, right, we are exploring a format of the 12 important question as an investor, right, might be in your mind. How do I go about it? The rupee has been depreciating, oil went up all the way, and today we are close to $90, right? So we have put up the 12 questions which we thought very important at this point in time and try to answer in a very structured manner because that's what as a capital allocator, I believe you form opinion with the data in a very structured manner. Post that, what we'll do, we'll also open up the Q&A where any other question which we have not addressed in these 12, we'll be very happy to answer at the end, right? So to start with the first question, Kamal, the slide is changing, right?
Yes, sir.
My portfolio did very well in 2020, 2024 phase, but now it's been sliding gradually, right? What should I do? I think we all experienced post-COVID a significant rise. So if you have to step back, Nifty was trading close to 12,000 index level. Due to COVID, the GDP hit badly. The market got hit badly. We hit a low point of 8,000 and then we recovered sharply. We went to a zone of 26,000, right? In a very structured manner from 8,000 to first we recouped to 12, 12 to 24 and 26. But after 26, now for 19-month period, we have been consolidating. So what happened is, if you have to look at the setup of 2020, so this is our three-pillar framework, market setup framework. 2020 March, the quality of the balance sheet was good. Growth got plunged because of COVID. We had a lockdown, extreme growth got plunged, but valuation turned very attractive. So those investors who allocated money in the COVID period or the post-COVID recovery, right, we had two things in their favor, but growth was little more negative. Actually, we had a negative GDP growth because of the lockdown. But what happened subsequently between 2020 and 2024? The lockdown got removed post COVID 1 and COVID 2 substantially. The lockdown got removed. The growth turned positive. Basically, it turned green. That is where the market recovered sharply from 8,000 to 12,000 to 24,000 to 26,000. But if you look at by end of September 2024, the market reached a place where it rallied far ahead of the fundamentals. What happened? Instead of having two greens and one red, the market set up at 18 months back was the quality of the balance sheet continued to be remain strong, both banks and the corporate, but valuation turned very expensive, particularly mid and small cap. Like a lot of companies started trading above 50, 60, even 100 PE multiple, which is generally considered to be a very high expectation zone or euphoric zone. And growth also was peaking, which I'll share it in the subsequent slide. So if you see the post-COVID, right, this is the EPS growth of the Sensex 30 companies, but gives you a fair idea. We were in a single-digit growth to we went to as high as a very healthy double-digit, close to 20%. So this is the recovery in which where the earnings also came through. The valuation was cheap at the starting point. There are a new set of investors who came post-COVID, right? So the fruits were really, really too good. But what happened at 2023-24? The base got caught up, the earnings started slowing down. So market took little more time to peak. So earnings started slipping earlier than the market. Market took little more peak. And if you have to look at now, interestingly, a very similar setup where after 18, 19 months of consolidation, you see a very good quality of balance sheet similar to COVID lows. But valuation today is not that cheap like COVID, right? Obviously, COVID lows was a very, very deep, cheap market. Today, post this recovery, if you have to look at market, starting of the war, the market fell close to 12% to 13% at the broad index level. and actually recovered close to half. As we speak, yesterday oil fell close to 9-10%, right? Hopefully next week also the market should recover. So today the quality of balance sheet continue to be very solid. Valuation, I would say, very good at large cap levels. Selective pockets of mid and small caps are okay, but it's not a very cheap market. Growth for 26, 27 is going to be a little more muted because of this war. I think this impact will be there for Q1. So I think instead of we looking at a very healthy 7% type of a GDP growth, we might end up having a maybe a 6 to 6.5%, right? Slight GDP growth impact will be seen due to the war and the post-war recovery. But I think this is a decent market setup like what we saw, but not very cheap market like what COVID was. The second important question, which is keep coming as a allocator, right? Lot of new investors came post COVID. I think the good thing happened to the market is now the investor base is broad based, both from the depth of the capital and the distribution of investors. Right today, across tier two, tier three city, lot more new investors have come in. But I think what happened post COVID, the market gave so much rewards. Everybody felt direct investing is easy, money making is easy, but I think last 18, 19 months, one thing we have realized, money making is not that easy like the way we perceived earlier. We need to be little more sharp. So if you are owning a direct equity portfolio and it's been corrected, the question keep coming, what should I do? Should I continue, reduce or exit, right? So these are the primary question. To answer this question, we thought how to think about investing today is you always as an investor should follow the earnings growth. So this is a broadly Nifty 50 top five sectors earnings growth. It doesn't tell the entire picture of the country, but it definitely tells you the big sectors how they are doing. Because if you have to look at lot of subsectors are part of the main sectors, right? It could be some small sectors servicing pharma industry. Lot of sectors are servicing automobile and engineering industry. A very good amount of segments like an IT company servicing banking industry. So this fine industry will give you a good idea where the earnings are going to come, how is your stocks have been positioned, right? So if you look at 27, 28, which is next 1 year and next 2 years, broadly the expectation of the earnings growth is between 15 to 17%. But these are estimates. This can get revised slightly downward due to this war. But primarily, we are moving from a single digit earnings growth to a slightly double digit. And if you have to look at the segments which are going to drive the earnings growth, for the 27, it's going to be automobile. We are seeing a very healthy recovery in two-wheeler, passenger vehicle, commercial vehicle will have slight blip. Tractor did pretty well, but the base is also very high. Banks is going to contribute significantly. Post this NIM pressure, we clearly see 27 and 28 banking is one sector where earnings growth is going to come. And if you have to see the last 2 weeks recovery, banking as one sector recovered very sharply. Consumer staples is not going to have any growth for 27. Primarily, ITC has some pressure on their entire profitability and a slow recovery expected in 28. IT services broadly a 7% growth industry. We have seen TCS results where even though they have grown 12% for the Q4, the commentary looks very weak and the basic estimates of the all the sell side is between 6 to 8% type of a growth. So this is an industry which is expected to grow 6 to 7% post this currency depreciation, right? So that's a very muted growth, I would say. Pharma going to have a little more muted growth for 27 due to Revlimid, but obviously in case specific, the growth can be higher. The whole idea is if your portfolio is positioned broadly along the lines of the growth, then I think you are in a better wicket. The next important question keep coming up is my stock has fallen, it has become cheap. So one of the very interesting data I keep thinking about is what has fallen, not necessarily cheap. And I give you one stock idea. This is basically a consumer name. I don't want to speak on the name of the company, but it gives you a very good idea, right? It's a pretty reasonably large consumer business, which went to close to 1400, traded more than 100 PE multiple. That's what I say, right? When you have 100 PE multiple, one thing is very clear. The expectation on the company is extremely very high. And when they don't deliver that, right, the market can get brutally fall, right? If you have to look at this stock, from 1400, it fell to close to 700, right? So 50% fall. And it consolidated for a year and a half time. It gave you a lot of window for a lot of investors after 50% fall also. One of the things which everybody says, right? 50% fall, the stock has fallen enough, it is cheap, I will buy the dip. But after 50% fall, also the PE multiple was elevatedly 60 times, 70 times multiple, which is significantly higher for a lower single digit growth for the company. What happened in the last 1 year, right? With this crisis, the entire stock again collapsed straight to 300, right? So basically, a first 50% fall, consolidation, another 50% fall. So one question is, if you have bought an overvalued stock and has fallen 50, 60, 70%, don't think because of its fall and it's cheap. Because it was overvalued and now the growth numbers are not supportive, that stock has fallen. For this stocks to revive or any other stock to revive, what you need to see is growth coming back sustainably. The balance sheet quality is good, dividend payouts are improving, right? So a lot of fundamental metrics has to change if at all you are owning a direct stock and has fallen deeply. Otherwise, general consideration is the easy money of this COVID recovery has been done. Now, a lot of investors are seeing a lot of stocks have fallen 50, 60%. We would definitely encourage you to take a hard review of your portfolio, seek someone who can help you to navigate through, ensure that the remaining capital is reallocated wisely. So that's where we thought we'll share this data. What has fallen, not necessarily cheap. The third question comes up is my portfolio was built for a different macro context. How do I reposition now, right? This is a very important because if you have to look at post-COVID, earnings came up, a valuation was cheap, we made money. Now, post this new administration in US, the macro policies are far more, I would say, volatile. That is giving both risk and opportunity. So we clearly see every investor today has to review their portfolio account with a 5 actionable metric, right? So we have actually posted this in even our LinkedIn page. So I will go through each one by one step, how we think about you have to prepare post this crisis, right? The first thing is you need to review your individual stocks or MF portfolio very dispassionately with the eye to details, seeing where am I now? Am I still convinced about this portfolio, or I should seek someone expert advice to think about restructuring the portfolio in a way where it can be future focused? The question to be asked is what is the expected performance in the next few years? That's the most important question rather than saying it has fallen. Now I don't want to sell it. No. If it is a bad one, we need to exit. That's the right strategy, right? The third question is any structural impairment due to this crisis. So this crisis clearly brought out few segments of the market was always weak, and this crisis have opened up and shown people they are not a very robust business to trade at 70, 80 multiple. So I think the first action is to review it very dispassionately without emotional bias, either by yourself or taking a helping of somebody who can guide you with lot of data and structured manner. The second thing we need to do is once you have done a very good review, the next thing which we would like to encourage people is to reconstruct the portfolio based on forward return because end of the day, at today we have to convert the entire holding into cost and see can we improve the return. So the one way we are at FPS Assets are thinking about is we are like to look for narrow themes which did extremely well in last 12 to 18 months due to this geopolitical issue or rupee. I'll give you two examples which gives you a broad idea. If you have to look at sector like pharma, did pretty well in the last 12 months, hardly fell, right? Because the demand was very stable. They do a lot of exports, so currency depreciation helped them. And I think this is the one segment where he did its job. Now it's your time to think about can pharma can perform next 2 to 3 years? Or is it a better window where I sell the low beta, which is pharma sector, and get into something which is growth driven, which could be a high beta? Think about the next important sector like an energy sector. So yesterday when I looked at the index post the close, right? You're seeing couple of index like metal index is all-time high, energy index is more than 1 year high, right? Recovered a lot. So we need to find ways in which where if any segment did extremely well in the last 12 to 18 months, and is there a window to reallocate capital, I think this could be a phenomenal opportunity so that you reduce the exposure in a calibrated manner where the assets have not fallen and redeploy the money into an area where there is a market dislocation, which could be a segment where the growth is coming, but the valuation is attractive, or some pockets of small cap funds. which is actually small cap. If you have to see, it's fallen close to 40 to 50% in a lot of areas, right? So maybe a specific fund, you get into it and try to capture a lot of alpha over next 2 to 3 years. The action number three, this is a very, very important for a lot of HNI investor, I would say, who have a very large exposure to PMS or AIF. What we clearly see is, since we have already gone through a 19-month consolidation of the market, and we clearly see today growth is coming back. And I'll give you one data where growth is coming back is little more confident is look at the credit growth. Today, as on March end, right, 13.8% is your credit growth vis-a-vis 11% in the previous year. Clearly reflecting economy is already in the uptake, and that is where we clearly see avoiding allocating incremental money to PMS with a variable fee. Because what happens post the consolidation of the market, typically market rewards in a bunches. Having consolidation has been done 18 months, there is a very higher probability, I would say, that we can have a next 2 to 3 years a very what to say above average performance, so that your 5 year return could be normal. Given this construct, right, avoiding a variable fee will help a lot of investors to save a lot of cost, right? So this is basically our thinking about. There are times where on the peak of the market, maybe you can think about variable option and then allocate money in a very moderate manner. But we as a house, we generally prefer a fixed fee product and definitely encourage a lot of investors to choose fixed fee over a variable fee. The fourth point is add some incremental capital to risk assets like equity, provided it in line with your asset allocation and the risk profile. Because we always say, right, being greedy when others are fearful. So having gone through 18, 20 months of consolidation in the market, now the crisis is about to end, right? If you have a long-term capital and you think you don't have an immediate goal and the risk profile allows you, your asset allocation allows you, these are the time to step up at least few percentage point more to a volatile asset like an equity. And it could be a good large cap fund, or maybe a bit of exposure into an alpha bets like a small cap, or it could be even an SIF, which is a new asset class got created, right? But I think this is the time to raise the slight amount of, I would say, risk quotient to capture the performance, because the war is also likely to come to an end. And we have gone through the consolidation, and hopefully, right, the next 18 to 24 months should be a little more better than what last 18 to 24 months, right? But definitely, if you have to be guard yourself, you don't have to go over out and increase exposure widely. But at least at this point in time, we clearly believe raising slight exposure makes a lot of sense. The last point in terms of the this is action five is create a checklist to update the performance of the both fundamentals and the price with a frequency close to monthly. We always encourage investor to look the portfolio once in a month and not daily, because Mr. Market gives you price every day. And we clearly saw a month back, it was very depressed. And the last 2 weeks, it is extremely euphoric, right? Instead of trying to see every day and ask yourself, am I in the right position? Updating yourself is important, but maybe a monthly frequency is what we suggested. Building wealth is a long-term game, and that is what we encourage a lot of investors to do. So, to sum and substance, we want you to create a good review mechanism, review your account at this point in time, the portfolio for the future, and create a checklist. At the end, what we clearly suggest right from FPS assets, always tell the investor your entire investment should be in one A4 sheet where you can review it at a very strategic level, have good clarity, and then you can actually progress pretty well, right? So a focused approach at this point in time can actually reward investor tremendously in next 3 to 4 years time. Moving to the question four, rupee has weakened. I think it's been one of the big topic in the market about the rupee. Those who have actually not exposed to rupee also, this has become a limelight because we hit close to 95 and there was a talk that we might hit 100, right? So one of the important avenue for NRIs, right? This is a very good window we consider for NRIs to increase exposure to India, and I'll share some perspective on that. The first slide is this is USD dollar INR chart. This is basically a monthly. If you have to look at this is a close to a 4 year return. 2022, 2023, rupee depreciated sharply. We moved from 75 to close to 83, right? So this is the time where straight 10 to 12 months we had a rupee depreciation. But what is interesting, which people forgot in this crisis, is from 2023 2025, approximately 2 year window or maybe a 1.5 year type of a window, we had a rupee which was primarily traded between this 83 to 85 band, right? So it went up, it went down, extremely tight zone. And post or the early part of 2025, the rupee broke down, and today we traded close to 95 to 92. So this was a steep fall, we agree, but we have to see this in the construct of we had a time period of a no depreciation. So actually what happened, since you depreciated less and you got overvalued, and with this crisis came up where we got exposed to oil crisis, the rupee fell very sharply and adjusted back. So the way to think about is rupee depreciating around 3-4% was normal. Since for a 2 year period between 23-25 it did not happen, the 25-26 early window become a little more turbulent. Definitely it was scary, but I think we need to see given the construct in which it behaved in the past. The one thing which I want to highlight very clearly is about we are not as badly positioned like what we were the previously. And I want to reflect on one tenure of the market, which was a very vulnerable for those investors who stayed for last 10, 15 years, is the taper tantrum, which is 2013, right? Where rupee depreciated close to 21% very significantly. I want you to look at two data points. One, if you have to look at our current account deficit, which used to be very high at 4.8%, right? Which was a reflection of a very vulnerable external situation. And if you have to look at our overall rupee depreciated also close to 21%, inflation was very, very high, close to 10. So in the past crisis, we had high inflation, high current account deficit. That's where the policy rates were trading close to 8%. If you have to look at current crisis, right, which is about to end in some form, the rupee depreciated a bit of 4% on the crisis. Obviously, before crisis, also rupee fell sharply, which commented. But if you have to look at our CAD, our current account deficit is close to only 1%, and our inflation is actually very, very benign. Obviously, this number will improve. The whole point is when we say macro construct is better than the past, I think we need to look at this data and see we are not in a very, very bad position. That's why, as an allocator of capital, we were consistently positive on the market, saying, I think we were a little vulnerable due to oil, but at a broad construct level, today we are in a far, far better wicket than in the past crisis. The second data to support why, how to think about this CAD is, so I'll give you one or two only metric which gives you a very good idea. We are basically a 4 trillion economy. We import close to 800 billion. This is the number which we need to remember. In that, oil is close to 200 billion. So when a 200 billion item moves up by 20%, you will add up $40 billion. So every $40 billion is 1% of the current account deficit. That's all number. So when the oil moved up sharply, the market felt current account deficit will come to 2%. And if it rises further, it go to 3 or 4%, right? That is where the panic got set in. But now oil has already come close to 90, which is also not a very conducive zone, but actually reasonably acceptable zone. We clearly see we will end up a current account deficit of 1 to 2%, which is not a very healthy scenario, but not a very vulnerable scenario. So this is where the rupee has depreciated significantly. The broad take is, I think the worst part of the rupee is reasonably done. From here, broadly, our thinking is it should be a little more stable rather than depreciating very fast. So if you have a long-term capital and always want to allocate to an growing market for next 10, 20 years, which is India, I think probably this could be one better time to allocate reasonable capital to Indian markets. The fifth question is, I have invested in PMS, how to judge the fund manager or the fund house, right? Because we saw the big popularity of PMS happen in the last 5 years. So we have created a very interesting 7-point framework. Obviously, there are a lot of content over here, but I'll quickly run through the 7 points, which will give you an idea about how we think about evaluating a fund house from a PMS point as a checklist. The first one is the depth of the investment team. What we want to see is whether the fund house is run by one individual or backed by a very capable investment team with a good research depth, right? Because it matters, right? Because if it's a one individual, right, I think that is a too much of a risk to carry to allocate a lot of capital. Because if you have to look at a mutual fund house, typically you will have one CIO, 4 to 5 fund manager, 20 to 25 research analysts. So it's the depth of the entire investment team is very wide. We don't necessarily need so much depth, but at least you need a capable people of 2 to 3 in the top so that it doesn't become a single man trick type of it. The second one is the business focus on the fund house, right? How many business the fund house actually focus on? Is the focus is only on the PMS? Then I think it's a big tick because as a fund house, they're very clear. They are into PMS. They're fully singularly focused, or they are focused into multiple businesses, right? Which also tells you the interest lies in multiple areas, and we need to be a little more careful on it. Not necessarily a bad sign, but we need to be a little more scrutinized if the fund house has a lot more objective, right, as an organization. Time over which the fund house is tested. Clearly, we see a lot of funds did very well in the COVID-led recovery, but that was a big bull market. Valuation re-rating happened significantly. The true test is to see the performance, how they did in last 18 months, how did they do previous to bull market. I think 7 to 8 year track record fund houses is where primarily you should look at. So when you choose fund houses, right, you need to ask the question: is the fund house have a 7 to 8 year to 10 year track record? Otherwise, you need to again have a higher level of scrutiny. The fourth checklist which we consistently want to follow is strategy integrity, right? Is the strategy is what they say and what they do, right? Because what we clearly see, having seen the funds, so there are close to 1,400 funds, right? We clearly see there are fund houses where there could be a slight difference in the way certain funds are matched vis-a-vis the benchmark or the nomenclature, right? So you need to really test it out. Is the fund is investing true to the label so that you compare a right PMS products to PMS product, right PMS product to MF to see whether post tax, post expenses, post the risk curve, which is little higher in PMS, does the result return commensurate what is being spoken, right? So this is the fourth thing. The fifth thing, we clearly see a very soft angle, but I think as a checklist for us, a distribution presence is there with the PMS because what happens, very few PMSs actually distribute and few PMS don't distribute, right? When we see a distribution will give you a little more credibility because the data is validated by the distributor. They have a better access to the information, which also gives you one level of due diligence, which otherwise becomes a very difficult to judge because end of the day, the entire the narration comes from the fund house, and we need to be a little more careful as an investor. The sixth point is portfolio growth. Clearly, we have created a scorecard for every portfolio, even for mutual fund and for the PMS when it comes for review. And I clearly see once the portfolio is put in, the metric should be it should have at least a 15% growth potential. Because I say, right, India itself is a 10% growth economy with a large cap expected to do 10 to 12%. A typical mid and small cap does between 13 to 15. So at least fundamentally, the portfolio should grow at 15 to 20. I would want to see more than 20 times, but at least 15 is a very good yardstick. So we have created a fantastic scorecard type of a metric for every PMS or every MF which comes for our review, and we share to our investors and give them our is a dispassionate view on this is your portfolio, this is what the growth to be expected, and it's up to us to see, right, whether it parts part of the portfolio or we should take any incremental action. The final one, as I've been telling, the fee structure should align with the long-term objective. We typically prefer a fixed fee model, and definitely today we prefer clearly a fixed fee model over a variable fee because we clearly see post the consolidation, the forward returns have improved. We want our investor to actually allocate a lot of money only to a fixed fee product. So these are the 7 checklists. These are the preliminary one. I think we have a very detailed review mechanism for PMS, but we thought we'll just bring you a glimpse of how we think about evaluating, and that gives you an idea about how the house is thinking and operating on in respect to PMS. The sixth question, what is the result season telling us? Because we are in the result season, I think it's very important to track the fundamentals, right? So before getting into the Q4, Q3 commentary itself was pretty good, right? That is why as FPS, we have been very bullish during the crisis. We have consistently communicated in both in LinkedIn and YouTube about this is a very good window where the fundamentals were improving before the war. The valuation was turning attractive because of war, and we actually raised, right? So as a house, if you have to see, we were close to 60% net equity for investor who have a long mandate. And actually, we moved close to 68 in this last, or to say 45-day window, which the market has provided. We are very, very happy about it. We did that keeping this data consistency, right? So if you have to look at Q3 itself, the growth got improved from 8% top line to 10. And if you have to look at bottom line, which is EBT, has grew from a single digit to double digit. So I think the growth is coming back, but growth is not coming back in a significant healthy double digit, but definitely a decent double digit. Coming to the Q4 is a very early days. A couple of days back, I've seen the numbers. 13 company out of BSE 500 have declared. Broadly, the sales has grown 9%, profit has grown 8%. Very early days, definitely post banking results, post industrial growth results, these numbers are expected to improve. But clearly, we are seeing a 12 to 13% type of a growth numbers. But most importantly, what we are also tracking is a commentary, how they are thinking now with the oil at 90 and a lot more confidence on the growth. The next 10 days commentary will give us a lot more strength on how to look for the market in the next 1 to 2 year window. So next question is, what are the top three themes which as a we clearly think very positive. Obviously, we are currently a distribution license for MF, PMS, SIF, right? So we are trying to see where all portfolios are aligned to this theme. So in our limited view, we clearly see capital market is one theme which will expected to do extremely well. And as I told, right, if you have to look back from yesterday closure, capital market index is close to all-time high. So clearly reflecting already in certain pockets of the market is hitting all-time highs, right? A lot of AMCs are hitting all-time high. A lot of wealth management companies are coming out, breaking out numbers also is happening. The second big thing happening in India is the nuclear play or an AI play. Power is going to play a very significant role. And I clearly see this technology, nuclear technology, will going to play a very pivotal role. So we are going to move as a country from 8 gigawatt to close to 100 gigawatt. And today morning, when I was going through the entire numbers, right, broadly, it's going to take 20 lakh crores of a capital needed to make this 8 gigawatt story to 100 gigawatt. So nuclear play is going to be massive. You can capture the entire theme by a lot of industrial companies, a lot of what to say, a rating business or certain business which will get benefit because these are very capital intensive capex. So a lot of long term money is needed and it can benefit the entire ecosystem. The third theme which we clearly see with this crisis, one thing which is very, very clear is domestic, and we clearly see this is going to be a multi-decadal theme. And I think every portfolio, when we evaluate right on a portfolio specific basis, when it comes to a review or allocating capital, we try to see how the PMs are trying to capture this mega theme and align ourselves to their portfolios. So this is one of the interesting side out of LNT, reflecting what our house view, right? Riding the growth wave, which could be nuclear, which could be defense or data center, which all comes in the part of manufacturing, right? The question 8 is how to think about MF versus PMS versus SIF, right? We are very familiar with MF because it has a 40-year type of a data, lot of history. I would say very high scrutiny has been done. I think it's pretty robust. Definitely, it's a mass product, but I think we can do a lot of curation in MF. PMS is a more of a last 5, 6 years. It has become pretty big, close to 1400 odd PMS is what we track at this point in time. And SIF is a new asset class. Obviously, it's a close to an 8 month. We have a very fantastic work being done in SIF. We have a dedicated analyst in SIF today to track every SIF at the market level because what we clearly see within hybrid itself, SIF has huge variety. It's a new asset class. We are very, very positive on the asset class, but we just want to communicate to you how we are thinking about this three. So for us as an FPS assets, right, MF will be the core. We clearly see with so much of data and the track record, we want to allocate our investor capital, given their asset allocation and the risk profile. Mutual fund is going to be the core. The best part is we are going to use SIF where it's going to reduce the risk of the portfolio. And I'll tell you a very interesting data in the last 1 month, in the month of March, a lot of SIF performed extremely well, which was not possible with mutual fund because SIF as an asset class can short the market, can be lesser exposed to equity, right? So we have seen a lot of hybrid funds fell only 1 to 2% negative when the market fell 11%, right? Clearly reflecting they are able to protect the downside far, far better than a very similar portfolios in the mutual fund, because the one ammunition which mutual fund doesn't have is shorting the market, which SIF has. So it's basically a very high-end product, but with a very less capital, close to 10 lakhs. So we are very, very bullish. So what we are doing in FPS is we are using couple of SIF product where we want to reduce the risk of the portfolio. So we are using SIF to reduce the risk of the portfolio, reduce the beta of the portfolio. That's a primary usage in which SIF has been allocated today. For us, PMS is all about alpha. Wherever we clearly see a 300 to 500 basis alpha over the mutual fund, right? As I told, given the nature in which the concentration of the portfolios can be much higher, the illiquidity of the portfolio could be much higher. Sometimes the expenses also could be little higher, right? So we clearly see a 300 basis should be a good benchmark if we want to allocate capital to PMS. And we as a house, having evaluated more than 100 and having empaneled close to 20, we're actively doing one or two only at this point in time, and but continue to progress in this direction. We clearly see wherever a 300 to 400 basis point outcome is expected better than an MF in a similar structure is where PMS is being positioned. So we see for a similar risk, we want more return in PMS, but for a similar return, we want less risk, which is where the SIP. So for us, MF is the core, SIP is to reduce the risk, and PMS is to add the alpha. This is how, as an FPS as such, we are positioning our clients and encouraging our investor to think about it. The last ninth question: how is our positioning, right, as FPS, which was 6 months back and today? That gives you an idea how the house has been thinking about the market. So in August 2025, right, we were very, very giving money only to open mandates like FlexiCap. So this was our big overweight position. We had a very curated list of FlexiCap where we were very comfortable about the manager who had a very good macro background. So we have chosen carefully fund manager who has a more than 5 to 7 year track record in the fund with a good macro overlay, because we saw this macro volatility was hitting very hard into the portfolios and it's not an easy market. Select thematic funds from a bigger institution who's been doing a phenomenally good job, we were able to allocate. And also we pioneered allocating a lot of index funds, primarily very broad-based index to capture any recovery. And we were completely underweight on mid cap, small cap, no PMS, no SIP was not even available. And there was no curated PMS at from FPS. But in the last 6 to 7 months, right, we have progressed a lot. And today, at this point in time, we continue to be overweight in FlexiCap. The second new category, which we have already created, called curated, where one of the fund house where we have an exclusive tie-up, and it's an alpha product, which is a small and mid cap and micro cap and SME with a very good fixed cost structure, right? So this is one curated PMS for alpha positioning where we are reasonably overweight. Selective thematic, we continue to be overweight. Index at this point in time has moved from a neutral or neutral plus to an underweight, primarily because of now markets have fallen. We clearly see a lot more alpha possibilities are there in next 2 years, and we want to allocate index fund, but little lesser than what maybe a 6 months back. SIP is a new asset class. We have been studying every day consciously. We are trying to talk to the fund manager, recording what they are telling and what they are doing. We've already seen a couple of funders have changed the strategy post the SIP they launched. So there are initial teething issues we are trying to address, think about it. But at this point in time, one product we have internally in terms of liking it and trying to allocate capital over there, which reduces the beta of the portfolio, but still can give a pretty decent exposure to the market performance. Mid cap, we continue to be underweight due to valuation. Small cap, post this correction, we went to overweight. But with this rally coming in, and if it has to sustain maybe in a month or two, right, this position is likely to come down a bit. And the final, it's a very interesting theme. We have seen in the last 5 years, a lot of new MF guys have entered into the market who have a PMS background. It could be a unified mutual fund, it could be a capital mind, it could be an old bridge. So a lot of these new institutions have come who has a very good PMS track record, and also they have come into mutual funds. So we are trying to differentiate the mutual funds into two buckets: one, a traditional mutual fund, as well as the PMS like mutual fund, and where we are consistently overweight at this point in time in a curated products. The 10th question, how do we think about long term? Because post COVID, the returns were very healthy. And right, one of the questions keep coming up, can I double the money in 3 years, 4 years? And I consistently say doubling in 6 years is the ideal time frame in which India is positioned, and no better data than what this data, right? So this is a 39-year data of BSE Sensex. It gives you a very good idea about what returns are possible in the long term. If you have to look at India's GDP for the long term grew by 13%, the markets delivered 13.4. But if you have to look at the last 10 years, GDP grew 10.25, right? The nominal GDP actually growing slower. The market is also rewarding only closer to it. So in the long term, we clearly see our return expectation should anchor to nominal GDP, and our nominal GDP is expected to be between 10 to 11. So in 11 to 12 will be a fair outcome in a long period of a time. And obviously, this is a broad market, right? So if you have to choose a good flexi cap, they can do a little better. A curated flexi cap with a PMS style can do a little more better. A PMS funds can do a little more better. So I think definitely the returns can be improved, but the base return expectation should be between 10 to 12%. So broadly, if we can double between 6 to 7 years, I think it's a fantastic pace. We need to understand today our FD returns are close to 6 to 7%, right? Given that construct, if we are able to double instead of 13 years in an FD or a 12 years in FD, we can double in the markets close to 6 to 7 years. That's a right way to think about it from a long term. Obviously, in 1 to 2 years, the markets can go ahead of us, so markets can deliver a lot more return and then can consolidate. But if you are thinking about 5 to 10 years, around 12% is a fair way to think, and that's what the history suggests. The last before question, where are we in the earnings cycle? We clearly see earnings cycle is going to improve. That's why as FPS Assets, we are far more confident. Next 2 years is going to be little more better from the price action vis-a-vis it, right? So this is our 9 quadrant matrix. We really like the matrix in a way. It gives you an idea. 24, 25, 25, 26. The quality of the balance sheet was good. Earnings growth momentum was very low, right? We had an earnings growth of close to 5%. But if you have to look at 26, 27 and 27, 28, the quality of balance sheet continued to be high, but the growth is improving from 5 to 6 to 13 to 15%. So we clearly see the earnings is coming. That is where next to 2 to 3 years, it's going to be a little more positive market than a quarter last 2 years market. The last question, what has changed, right? Definitely two things has changed. Our market has become a lot more cheaper than 18 months back. If you have to look at a very interesting metric which Morgan Stanley has put out other day, if you have to compare Sensex in gold ounce, this is the cheapest level in last 34 years, right? So if you have to look at this is the high, this is low. Now, if you have to look at, this is a week back data, if you have to convert the entire Sensex in gold terms, the cheapest at this point in time, right? So what it tells you, if you have to choose between allocating money between markets to gold, maybe the risk to reward today better in the market than the gold. So obviously these are very long-term data, doesn't support next 3 months, but I think this gives you a very good idea which segment of the market is cheap and which segment of the market is not cheap. The second important metric is price to book. Clearly today we are trading at lower end of the price to book after the consolidation. And if you see before COVID, the market was 12,000. Today we are at 24. In a 6 year window, we have just doubled. So I think our market is not a very expensive market, but neither a very cheap market. So it's actually a neutral market where we steadily allocate capital rather than allocating either aggressively or not allocating, right? And if you have to look at our performance vis-a-vis our peers, which could be the entire MS here, it's one of the lowest point, clearly reflecting the deep pain point of underweight. Huge FIS selling is already reflected. I think what we clearly see in next 2 years, a lot of this catch up can happen as our execution improves. And that is what, as an investor, right? If patience is something which you can give it to your portfolio with the right mentor to anchor you and have a very good portfolio, right? Maybe next to 2 to 3 years, there is a very decent chance to make far better money than what last 2 to 3 years. The last thing, growth initiative done by policymakers. We have seen rate cut, liquidity. We had seen tax cut and GST cut. NBFC credit growth is picking up. Government capex is picking up. I think a lot of growth efforts being done, and we have seen this very consistent. Even the last RBI policy where the rates kept constant, and they're leaning towards more to growth because we clearly see we need better growth. And hopefully, with oil at 90 or maybe if it has to drift far lower to an 80, right, the risk of inflation will go down. Possibly an El Nino risk is there, which we have to monitor. But I think current policy structure is growth positive. So as an investor, right, that should be what should give you a lot of excitement on a 3 to 4 year outlook. To end, the last thing, economic cycle is good or okay. Earning cycle is okay at this point in time, will get better. Moderate your portfolio risk. We clearly see if you are overexposed to individual stock or overexposed to a lot of micro caps, got butchered, this is the time to review it, get some expert consent, review it, position your portfolio for the future focus, and actually enjoy the benefits of the economic recovery. Volatile market gives you very good time to build future focused portfolio. So I always encourage investor to see the portfolio, how it can perform in the future instead of thinking about, oh, it has fallen now, let me recover in the same place. Not necessarily. The fourth important point, sales driver will be the biggest driver of value. We clearly see with inflation coming up, sales will pick up in a lot of corporates, which is going to be long-term positive from an equity market standpoint. In the end, we clearly see risk to reward is far more favorable in large cap. That's why we giving a lot more mandates to flexi cap, which typically invests between 70% into large cap, and a very selective exposure to small and micro cap, primarily 1 or 2 funds on a specific way or a PMS, right? So we clearly see next few months is going to be a very good window if you restructure well, position it well, with corporate earnings coming right in the next 40, 45 days, lot of commentary. I'm sure as an investor, we'll benefit in the medium term. Happy investing and thanks for all your time. We'll be very happy to answer any further questions which we have left out in the 12 important questions which I have answered. Thank you. Over to you, Komal.
We request all the participants to type in their questions in the chat box.
This is a
While
disclaimer, just for your
Yeah,
purpose. We are an APME registered a PMS distributor and AMC registered a mutual fund distributor. This is the contact details. Yeah. You can type in the questions if you have anything in the chat box.
yes, so Mr. Raghuram is asking, what is your view on banking sector, both private and PSU banks?
Oh, thanks, sir. It's a wonderful question. We clearly see we are very, very positive on banks, but we're a little more positive maybe today at this point in time, private over PSU, because we have to see PSU banks did very well post-COVID. That's primarily one. The asset quality cycle improved tremendously, right? That helped a lot of PSU bank to report low GNPA. They recovered the past crisis of GNPs, right? So they had a lot of recovery, which led to a profit boost. And we have seen a very classic, the largest bank in PSU, SBI, did phenomenally well between 2020, 2026 cycle. But we clearly see in this incremental cycle, banks itself will do well from one, the rate cycle. We are in the end of the rate cycle. Maybe we will have a rate hike. which can be positive from a NIM point. I think credit growth is picking up, as I told, right? Credit growth is picking up from 11% to close to 14%. And with this inflation coming back, we can go to 15. The only big pain point today at this point in time is the deposit growth. If banks can find out the ways and means in which either they can get the deposit up or the recycle the capital through securitization, I think they can able to fund their balance sheet to grow well. And valuations at this point in time is pretty attractive. So we are very, very positive on this sector. Obviously, right, as an FPS, we are allocating capital using either a particular index funds in the banks or particular funds which are very focused on to it, right? But we are pretty positive on banks from a next 1 to 2 year window point of view.
Thank you, sir. The next question is from Mr. Arvind. He thanks you for this very insightful
Thanks,
presentation. And
thanks.
he's asking, given that the FII flows are still focused on Korea and Taiwan with their high growth narratives, whether India can expect FIIs to return with lower nominal GDP growth.
I think a very good question, Mr. Arvind. So what happened is, as you rightly pointed, Korea and Taiwan did extremely well. And I was just looking at their EPS growth estimate for 27 and 28. Their 27 EPS growth estimate for both Korea and Taiwan is upward of 100% vis-a-vis India's 15, right? So definitely FIIs are currently, who has a 1 year outlook, they have a far more incentive today to be in a Korea or a Taiwan because the growth lead is coming there. And you know but this growth is coming from a very narrow stocks. Samsung, Taiwan Semiconductor, S-minus Hynix. So it's like a 3 to 4 stocks or a semiconductor or AI theme is the only theme in town. What we clearly see, if you have to look at 28 estimates of the growth, their growth is also close to 20% and India growth is also 15 to 17. So we clearly see next 1 year, this growth momentum challenge is there for India vis-a-vis them. But if any FI or any investor who has a 4 to 5 year outlook, right, clearly we see India as a better wicket because in 28, our growth is closer to it. My sense is 29, 30, right? We will have far better growth than them because for them, it's all about AI. Already they're hitting a cyclical peak. And from there, the base is catching up. So we clearly see maybe this headwind can stay for next few months. But as an allocator, right, what we need to see without FI itself, the market has recovered sharply. So if you have to look at the last 2 weeks recovery, market has recovered substantially with a FI selling of $3 billion. Think about when FI were to come back in this market, definitely I don't think we'll be able to allocate capital, right? The market's going to take a big turn up. So I think the window is still open. If you have a 5 year window and want to increase exposure to India, maybe next 8 months time is going to be relatively a better time where maybe a big FII money might not come. But our whole sense is for FII, it is always a relative trade. I think 27 still growth outlook of Korea is good, growth outlook of Taiwan is good, growth outlook of US is also good. So I think it's going to be a little more challenged. But any FI who can look beyond 27, which is 1 year out, I think India will definitely come into play. We have far more better nominal GDP growth than any other country. The only thing is we don't have today AI trade, and that is where FI money, which is looking at an AI trade, is not coming into in India. But we clearly see they have sold out tremendously. To give you one data, 2025 they already sold out close to $18 billion. 2026 already they have sold out to $18 billion. So close to $40 billion, right? Roughly between these 2 years and maybe some bit of selling before. Huge selling has already been done. I think we clearly see they have from overweight, they have become neutral weight. And with growth coming back, I don't see big selling is expected. Obviously, in the short term, they can sell us. But in the medium term, clearly, after this AI narrative will slow down, right? At some point in time, definitely India will be considered. This is what our primary thinking.
Thank you, sir. The next question we have is from Mr. Dilipan. Mr. Dilipan is 33 years old and his overall portfolio is 67% equity and 33% fixed deposits. He's asking if he can increase his net equity exposure in the current market time.
I think, thanks, Dilipan, for the question. It's more of a very personal in nature, but you are well exposed, right? So I think clearly your question is very valid, I would say, right? End of the day, market can give us opportunity. What is our limit, right? It could be from asset allocation and risk tolerance. I think you're well exposed. If you think your asset allocation only permits 67, right? 2/3 into markets and 1/3 into a non-volatile, I think you're very well positioned. Any recovery of that should do very well. The only thing where the 67 is positioned is the question which you need to ask. Is it positioned brilliantly? Is it positioned in the portfolios which can reward far more better given the macro construct? I think if at all you can think about it and work around, I think you're well exposed. You don't have to increase if your asset allocation doesn't permit you. Let's say if your asset allocation were to permit you 100% equity, maybe increasing few percentage point at this point in time makes sense. So I think I'll leave that to you, or maybe you can consult with someone who can guide you. But always invest with your constraint, right? The market is something one. Second, I think where is our asset allocation? What is our risk tolerance? I think we need to be very, very careful and then bring everything together. This is not a very high return market. This is not a very, very low return market. This is a neutral market where in line with the long-term return, you can think about getting a 10 to 12% from a volatile asset like an equity, right? Given that constraint, you plan accordingly and then allocate capital.
Thank you so much, sir. If the participants require an even detailed answer, they can contact to the numbers given on your screen. The next question we have is from Mr. Vardarajan. He's asking, what is your plan on Gift City products to leverage for currency hedging?
No, I think we are closely working on Gift City. What has happened is now, if you have to look at last 2 years, right, the most overvalued markets are the global markets, in our view, because I think the AI rally has taken off big time. So I was looking at yesterday's one of the data where most of the markets last 1 year has performed, or every market globally has performed between 30% to 100% vis-a-vis India, right? So we clearly see today a lot more value in India vis-a-vis a global. But definitely, we are exploring a Gift City product. These are very, very new breed, I would say. It's getting far more familiar. But not only to leverage currency, I think to leverage currency, we can have exposure to many of the overseas fund, even in mutual fund. But I think our whole take is Gift City will open up new window to allocate capital. We are actively working. Maybe it will be a one-to-one conversation and see which Gift City product can suit into an investor bucket. But definitely, we are very, very positive on this new. I would say it's like a new asset class type of a category because you can invest on the same currency which was not possible earlier, and you don't have to take a lot of efforts to open an overseas account and do a remittance and then invest, right? So I think we are very positive, but currently it's not a very actively pursued because very early days in Gift City.
I think, sir, your voice was getting stuck in the middle, but sir, at the end has summarized the whole Gift City question. The next question would be from Mr. Money. He's asking what would be the max number of mutual funds in asset allocation, 4 concentration spread across different categories or 10 diversified spread across different categories?
A very good question, Mr. Manisha. I think we clearly see you have to diversify at various level. It could be starting from fund house, right? We want fund houses who have a very long track record, and maybe some fund houses who have a very short track record, but they're doing a brilliant job in terms of having a very unique portfolio or a portfolio which is far more nimble to the macro environment, right? So that's the first thing you need to diversify. Second, among the diversification, you need to be a little more flexible mandate than the narrow mandate. What has happened post COVID recovery? A lot of money has gone into thematic, extreme money has gone into micro cap, small cap, saying that's the only way to make money. But I think clearly last 18 months have reflected that's not the way. I clearly believe we as an allocator of a capital should give a little more broad based than a narrow mandates. Third, obviously, 10 to 12 funds are a very good option to build a good portfolio because every typical mutual fund today has between 60 to 100 stocks, right? If you have to like, and if you have to allocate money to a small cap, they are between 100 to 200 stocks. So if you have 10 funds with a unique overlap, you cut down, you will be exposed to 200 to 300 stocks. I think that's a phenomenal diversification. That's all someone needs. As I keep telling, you can't have a zoo of product, right? So if you have a money, more than 20 should be cutting out. Between 10 to 15 is a very great window. As long as you bring 15 very differentiated products and not a very similar product, good amount of diversification can be achieved using mutual funds, SIF, and maybe a PMS. Hope I answered your question, sir.
So, Mr. Dileepan thanks you for answering the question.
Thanks, sir.
So I think we can wind up our Q&A session. Okay, there's one
Right,
more
I think the
question.
last one. Yeah,
Yeah, we'll take this last question. Mr. Raghuram
yeah,
asks, in the
sure.
current market situation, if the rally starts, which sector will be good, large cap, mid cap versus small cap?
Okay, I think it's basically market segment rather than a sector. Our whole idea is instead of we saying where the rally will come, I think what does our asset allocation is guiding, what is our risk tolerance? Because the depth of water in a small cap can be very brutal. We have seen, right? The funds can fall 30-40% vis-a-vis a large cap can fall 10-20%, right? So I think we need to first ask the primary question. We clearly see today large caps are far more reasonably valued than a small and mid cap. So large cap will be a very preferred, but maybe a broader mandate like a flexi cap, which captures that good portion with a little more growth curve tilted. Small cap are fallen, but they're not very, very cheap. So you need to be very, very selective. Mid cap at this point in time, we are underweight as a house because it's a very narrow bucket and the valuation continue to be very, very rich. A good combination of a large cap using a flexi mandate and index and bit of that, and maybe icing on the cake with a small cap and maybe SIP or STP in a small cap, slowly staggeredly accumulating is something which is what we have been. But it's more of a very personal choice rather than a very generic answer. But this is how the house has been thinking and house has been allocating capital. Hope I've answered your questions.
Thank you, sir, for this wonderful session. We all would like to thank all the participants for giving their valuable time joining us on a lovely Saturday morning. We
Sure.
hope you have a great weekend ahead. Thank you, Will.
Thanks,
Thank you,
thanks
everyone.
all for joining and hope it helps you to take high quality decision. As an investor, I always say, right, we have to control the controllable, allocate capital wisely, and enjoy the fruits of the economic growth. Wish you a very happy investing. Thank you. Bye.
Thank you, everyone.